The following podcast was recorded on Thursday, August 25th, 2022, featuring Sam Rines of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Sam Rines of Arbor Data Science. Welcome, Sam.
Hey, good morning, Kristen.
Today, Sam will give us a look at the return of Meme Stock Mania. Sam, current market conditions include high energy prices, food inflation, housing costs, central banks raising rates, and now we can add to the list the return of meme stocks. What's driving this most recent demand?
It's really interesting. If you look at the number of things that could be, called negatives for the market, they're through the roof, right? We're in the middle of a tightening cycle. Home prices are collapsing, home sales are collapsing, mortgage rates are rising. I mean, you can just go through this incredibly long list of headwinds for the market, and yet you have GameStop back in the news. You have AMC doing a dividend of a ticker symbol APE. I mean, it's incredible. You have Bed Bath and Beyond, basically a failing retailer, going sky high on an earnings release that was, call it, unmeaningful because of a bunch of people on Reddit. I mean, it's back, and it's a really strange phenomenon. But at the same time, it's one of those really, I would say, nearly predictable things that we kind of built this narrative, coming out of COVID, that, whether it's Davey day trader saying stocks only go up and reaching into the Scrabble bag and pulling out a ticker symbol and saying, I can beat Buffett by, just doing this. We built a mentality around the stock market that instead of it being a tool for longer term investing, it's almost, for at least a subsection of retail investors, a place to go and speculate and try to make a quick buck. I mean, it's very reminiscent of, call it 98, 99, 2000, in that respect, at least.
And what's the correlation between Twitter mentions and stock prices?
It's pretty funny, particularly with the meme stocks, right? It's all about the meme. It's all about the headline. It's all about the hodl, diamond hands, etc. So when you begin to have some momentum on Twitter about, hey, let's pile into XYZ, or let's do something here, you begin to see those stocks move, partly because they, one, have typically a significant short interest, and therefore you can do a little bit of a short squeeze, but also because people get behind it in mass, right? It's a lot of retail investors putting in a little bit of money each that begins to really move things in ways that don't make sense from a fundamental market perspective. So there's a lot. This is mostly a news and event driven type market, and much less of a, oh, this is a great company for the long run type deal. And you can see this with Bed Bath and Beyond. It's nearly perfect on the call it the Twitter correlation, where every time you have an uptick in Twitter mentions, you typically have some sort of move either happening or about to happen.
And tell us about college student Jake Freeman, speaking of Bed Bath and Beyond.
It's just one of the most interesting stories, where a college student, mysteriously has $25 million to put into Bed Bath and Beyond, and ends up making, 4 or 5x his money. Ryan Cohen, he's an actual player in the market, and, he made quite a bit of money on Bed Bath and Beyond as well. And the story around, call it the misinformation that was floating around Twitter, is just phenomenal. Like, that they couldn't actually sell the stock because they own too much of it, blah, blah, blah. That these guys were diamond hands and were going to actually stick around a meme stock that theoretically, these were semi-sophisticated to very sophisticated investors, that somehow they were going to stick around something they knew wasn't worth what the current price was. It's a phenomenal tale of, we're just going to push this thing up, rip the faces off of a few shorts, and then bail and, basically have the liquidity of the Reddit trading mob to get out from under it with a profit. It was a brilliant, almost, it's like a typical pump and dump scheme in a lot of ways, where you pump up the stock via a whole group of individuals, and then a few big ones sell to the last ones in. So it's both a really, really intriguing tale of making a lot of money and a really sad tale of some people getting stuck in a stock that probably doesn't deserve a lot of capital.
And how about the role of stimulus? How did it help drive this phenomenon?
This is where I think this actually gets to be one of the most interesting conversations we could have right now, particularly with the student loan forgiveness that was just announced. Right, this phenomenon was very, very much a stimulus-driven phenomenon. Right, these stocks were not something to pile into before there was extra cash floating around during, and there was nothing else to do. I think that's a pretty important kind of caveat to the fiscal stimulus front, right? You couldn't go out to eat during COVID. You couldn't go spend that money call it on a vacation or on much at all. So what did you do? You sat at home and you either speculated on stocks or you worked, and you could kind of do both because you were working from home. As the fiscal stimulus worked its way into the economy, these stocks began to really move because there were a lot of people that were interested in kind of getting into the game of making a quick buck. If you look at Reddit with GameStop, it was a brilliant move, right? GameStop had a huge short interest on it, partly because it was a failing retailer with very, very little business prospects in the out year. And kind of the same thing with Bed Bath & Beyond, failing retailer that had very low prospects in the out years, but yet, they were very cheap stocks. They had very high short interest, and if you piled into them, you could squeeze those stocks higher. So when there was a lot of free money floating around and no sporting events to bet on, it was kind of the easiest way to, go out there and get a lottery ticket.
In your recent post, Sam, you have a good quote I wanted to include today. It was far more interesting to put money down on a lottery ticket of failing companies surviving, but nothing lasts forever.
Yes, and that's the case here, right? As soon as you began to see the fiscal side of the stimulus begin to work its way out, and you can kind of see from the Hutchins Center here that you have had a fiscal stimulus decline, right? It's been a drag, not a positive. As soon as that began to happen in a meaningful way, you began to see those stocks come back down to earth. I mean, GameStop's still high, and Bed Bath & Beyond is still higher than it probably should be, but you began to see them come down. What'll be interesting to see going forward is whether or not the student loan forgiveness begins to, at least in the back of people's heads, give them incremental capital to begin to go back and play the game that they were playing 6 to 12 months ago. I think that's going to be a really interesting story around, maybe, it's probably not inflationary, but it could, in a meaningful way, but it could be a problem for the Fed when it comes to speculation of such.
And you've mentioned meme stocks as being a leading indicator. Could you expand on that?
Yeah. So meme stocks are an interesting leading indicator of a couple of things. One, I think it's a leading indicator of what the Fed has to do in terms of tightening. If you continue to have a massive amount of speculation in meme stocks, it's kind of telling you that there's still an awful lot of froth out there in the economy, and you probably haven't had as much of an effect of tightening as you suspected, right? Yes, housing might be going down, but if housing's going down and GameStop's going up, that kind of sends a little bit of a mixed signal as to what's really going on. So I do think that it's a little bit of a leading indicator when it comes to speculation in the market and what's going on, but it's also a leading indicator of much broader things within the policy side, both call it marginally on the fiscal, but very much so on the monetary.
And Sam, in summary today, what should we be watching for next?
I think it'll be really interesting to see how some of these stocks react, call it through Jackson Hole and through the realization of the college debt forgiveness. I think those two things will be very, very interesting to watch, particularly with Jerome Powell coming out tomorrow and giving us a little bit of a take on what's happening and kind of how to think about it. So I think really next week will be the test of whether or not you're going to continue to see the meme stocks take off and how that's going to work. I think it's also interesting to watch the creativity of some of these meme stocks to continue the memes. right? You had in just kind of the AMC buying into a gold mine. I mean, that was ridiculous. Then you had AMC give an ape dividend. Kind of how they begin to, or how they have to work to keep the narrative going. I think that's going to be really intriguing because it's going to be hard. It's really hard to keep people's interest over a short time frame, never mind an extended time frame to continue holding and buying and pushing these stocks higher. So how companies continue to keep the meme rolling, I think is going to be one of the more interesting and intriguing things to watch as we finish up 2022.
Thank you, Sam, for your thoughts today. Thank you, everyone, for joining us. If you have any questions about Bianco Research, Arbor Research, or Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.